All right, let's get started. Okay, so good morning to you guys. This our second day, and for those of you who've made the sacrifice to be present here on time, congratulations, bravo. At least I will be taking note of those that are, keeping to time. As a very busy person, I have little time to spare. So the one that we sacrifice, I believe it should be respected. So those of you who are making out time to be here on time, that's really very remarkable. That is where the discipline actually starts from. Like I'll always hamper on, for you to really be a successful trader, you have to be disciplined. There are no two ways about it. If I'm going to give you the best strategy here, tell you the best things to do, if you as a person are not disciplined, you've not yet trained yourself, you know, to master yourself, master your own self, you will find it difficult to stay consistently profitable in this business. So, what I'm saying in effect is I really admire those who keep on time. Okay, with that said, the next thing I would like to talk about is I will be checking the chart. You have your chart section here. Okay, so I'll be checking it from time to time. If I ask questions, I would like you to just be responding on the chat. Don't turn on your audio, okay? This class is being recorded, so we don't want it to be messed up. So you just answer. Let's say if at some point I think maybe the network is giving issues and I ask whether you can hear me or not, simply type yes, simply type yes or no on the chat screen, okay? So that will kind of help me to know whether you guys can actually follow what it is I'm saying. If I ask whether you understand or not, you are also permitted to answer via the chat window. The next thing is if you don't understand anything, any concept, anything I've just said, I will be, like I said, be checking the chat from time to time. Type your question on the chat, okay? Possibly after the class or during the class, I will look at your questions and I'll answer it. I'll be making time, 5 minutes intervals inside of the class to check if there are questions there. They will be answered. Okay, without further ado, let's get started. I will have to, okay. I trust everyone can see my screen now, correct? Type yes or no, please. Let's do that within the next 5 seconds. Can you all see my chat screen? Great, great, great. Okay, so the last time we talked about some of the fundamental concepts. We talked about some of the concepts that you would. Is someone complaining? Somebody's asking how you can join. Join here, please. Join here. Who's this? Okay. So we covered a lot of concepts the last time. We talked about lot sizes. We talked about the, I believe we talked about the bid and the ask prices as well. Some of the fundamental things that you need before you enter a trade. We also talked about leverage and what a margin account is. I think we didn't talk much about broker, but we pointed it out. So maybe before we kickstart what we have today, I'll just point out just something brief about brokers, the two basic kind of brokers we have, and why you should possibly maybe choose one over the other. Then we also talked about what else? A whole lot of things that we covered: the buy and the sell, the bullish market, the bearish market, that the market is going up or whether it is going down. We kind of pinpointed a number of those. Did we talk about, how many of you here were present in the last class? Did we talk about a candlestick the last class? Did we explain the candlesticks? The high, the open, the close for the candlestick. Did we talk about it? I
Yes.
think we did. Great, great, great. Okay, so with that said, what we want to do today is we want to go deeper into talking about what a market structure is, the kind of market structures we have, and how you should respect market structure when you want to place your trades. Okay? So, like I promised, before we talk about the market structure, which is what we really have for today, let's talk a little bit about brokers. We know how the brokers from the last class actually help us in our trades, right? We saw that the broker, once we make any deposit, they take our money, the money that we've deposited. The broker takes the money that we've deposited as what? As a collateral, and then give us the amount equivalent to our leverage multiplied by our deposit as the capital for trading. That is why we call it a margin account. And we saw from the last class that the margin actually helps us to maximize the profits from our trade. But if it is going against us, that's where the wahala comes in. It becomes, a very difficult thing for us, when the market begins to go against us, right? But if the market is in our favor, the leverage that the broker gives to us really serves as a very important factor to making huge profits from the market. So that we are all covered. We talked about the pips, the pipettes from the class, how to make some calculations on, okay, how much the market has moved in your favor or against you. We talked about the lot size, the standard lot size, mini lot size, and all of those things. So let's get started today. Like I said, today we'll be talking about market structure. Let me write it on the screen. We'll be talking about the what? We're talking about market structure. Okay, good. So underneath this market structure, we're talking about uptrend. Today, at least, people, even for those of you who are old traders, you will know how to draw a trend line correctly. Not when you do a line, cham, cham on the screen, you say you've got your trend line correctly. Most of my students, they have mastered the art of drawing trend lines. But most people I've seen that call themselves traders is because of wrongly drawn trend lines, they have made some very heinous mistakes. Either they miss to make an entry on the market, or they fail to take profit at where they ought to have taken it, and the market will now move against them. So we have what we call the uptrend, we have the downtrend, okay? Then we have the ranging market. This will be covered today in very great detail. When I mean detail, is unlike the details that you might have learned elsewhere. Okay, so before I promise to cover the broker, before we delve into this, we have basically two types of broker. You need to be wary of this. Most of us are scalpers. Most of us are swing traders. Most of us are day traders and position traders. So which broker is right for you? Which broker should you always be looking out for? We have basically two types of brokers. We have my favorite, we call it the ECN, the Electronic Communications Network. Electronic Communications Network. Okay. Then we have what we call the what? The market maker. Okay. We have another type of broker that we call the market maker. Market maker. Now, the ECN is also called the non-dealing desk. Okay? Non-dealing desk. All right? While the market maker is also known as the what? The dealing desk. Now, what are the differences? Who are they, and what differentiates between the two? Now, Let's start with the ECN, okay? Electronic Communications Network. Remember that when you are buying a particular currency, right? When you are purchasing a single currency, what it means is that you are selling another currency. Take for instance, you have your um, GBP USD, all right? You want to sell GBP, that means you want to buy USD. And if you want to buy United States dollars, that means you want to sell British pounds. For those of you who are totally new to Forex, we covered that in the last class, the currency pairs, their meanings, and all of that. So, buying a particular currency means selling the other currency. For instance, this is a pair. This is a currency pair right now. Okay? This right here is a currency pair, GBP USD. Right? Now, GBP means British pounds, USD means United States dollars. If I say I want to buy GBP USD, what it simply means is I want to buy pounds, but I have dollars to buy it with. Are you getting the point? Now, there has to be somebody somewhere who needs US dollars and the person already has pounds, so that the transaction can be brokered between myself and the person. Are you getting this? Now, there has to be someone somewhere around the world that has to have USD and the person in need of pounds. Yes. If I want to buy pounds, yes, that has pounds but is in need of USD. So if I am providing my USD to purchase the person's pounds, okay, the person will now be doing what? Buying my own USD and selling me his pounds. Remember myself, I am doing what? I'm selling my USD to buy pounds from the person. Now, the kind of broker that stands between us matching this order for myself and the other person directly is an electronic communications network kind of broker, an ECN kind of broker. Now, what this person literally makes from the market is the what? Is his commission for matching us on this particular trade. That is how he makes his own money. All right. For those of us who have used Binance to trade, Binance is a pure ECN, because if you go to what we call the order book in Binance, you will see how orders are coming in, buyers and sellers are coming in and going. These are people all around the world converging. As you are making a buy, someone else is picking it up. You will see that if you are using the mobile phone to make the trade, by the right hand side, depending on the template you've set, you will see those areas that you have green, 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 and the bottom part you have red, red, red. That position where you have all those red are people that want to sell at their specific prices. And those areas that you're seeing green, green, green are people that want to buy at specific prices. You can simply come into that particular platform, okay? Can come into that particular platform and check a price that suits you and buy from that person. That is how ECN network does. And as we know, for every transaction you make on Binance, they take what we call a maker and taker fee, about 0.2% in total. All right. So whether you lose money or you make money, they don't care. It doesn't concern them. They make money from those commissions. That is ECN. Okay. They are matching you. Take note of this. They are matching you directly. Do you understand? To another trader. Now, the problem that ECN might have is, let's say you want to make a certain kind of purchase and at a certain price, but the people that are willing to sell you at that particular price, the volume you need might not be enough. Do you understand? That's where you have what we call slippage. Are you getting the point? A term we call slippage. Let me write it on the screen. There is a term we call slippage. Let's assume I want to buy $10,000 of pounds at $1. All right? $10,000 of pounds at $1. Then the order available in the market is only worth $7,000 worth of pounds. But higher above at $1.5, I can get additional order of what? At $1.5, I can get additional volume of 3,000. Do you understand? So even though I placed an order to buy $10,000 worth of pounds at $1, what the market might do at that point is refill my order $7,000 worth at that $1 which was available, and then it will now slip to a higher price of $1.5 to now fill the remaining 3,000. This happens almost every time in the market, especially when there are high volatilities in the market. All right, so that is slippage, and that is what an ECN broker is all about. Now, on the other hand, you have who we call a market maker. All right, now these market makers are like the big boys. They match your orders, they provide 247 liquidity for you. How do we mean? What they do for themselves is this: if you place any order, instead of waiting for someone else somewhere around the world to place a counteracting order that they will match you with, they already have the money within themselves, they have the volume within themselves, so you are directly buying from them or selling to them. That's how the people we call the market makers. All right, and we say they have a dealing desk. They are like the big boy, the casinos. Do you understand? Now, these casinos, they have all the things you need. And one thing about them, why most companies usually prefer going for the market maker is, most companies usually starting market makers is because of the statistics in forex trading. Now, listen, guys, when you use an ECN, there is no conflict of interest. What do you mean by conflict of interest? The money you are making or you are losing is with respect to the market forces. It's directly linked to market forces. You are buying from someone you don't know that is living somewhere in the world, around the world, and now you've purchased it or you've sold it to him. Whatever money that you make or whatever money that you look is all on you. Okay, now on the other hand, for market makers, what usually happens is this: because they believe that 90% of traders, or even 95, I don't know what the current statistics now is, right, that 90% of traders lose money, that this young man coming to their platform for the first time is likely going to be what? A loser trader, a losing trader. That is the assumption they have in building their, and like I will always tell my people, numbers don't lie. The statistics will always play out. When someone has gathered enough data for a statistics and is building a business around that statistics, believe you me, that person is well informed. Okay, now when you lose money when trading with a market maker, the money that you lost actually goes to them. Do you see that? It now appears like you are competing with your broker. That is where the conflict of interest now comes in. So for a market maker, aside from making money from the spread, from the commission, they also make money when you lose your trade. So this will now open your minds to the fact that it is not of the good intention of your market maker for you to be a profitable trader. Do you understand this? Does that make sense? Please type in yes on the chart. Use the chart. Type in yes or no if you don't understand the difference between the ECM broker or the market maker. I want to see responses. I want to see responses within the next 5 seconds, please. If you do understand the difference between ECN and market maker, let me know. If you don't, point it out. Let's be quick about that. Are we there? All right, beautiful. I get beautiful, beautiful. Now, that is the market maker and the ECN. Now, what market makers usually do is this, okay? That is why most of these smaller brokers that you see, you guys know them, I don't want to call names, that will always bombard you with adverts anywhere you go, just for the simple fact that you've typed Forex on your Google. Anywhere you open, you will see their adverts. Most of them are market makers. They have designed their systems in such a way that if you are not careful, you will lose money. All right? If you are not careful, you will lose money. If you are trading on very low time frames and you are not a good trader, you will lose money. So, and whatever money you lose is going to them. Do you understand? That's why they're able to afford those millions of dollars in adverts. All right? Now, there is something we call stop hunting. Remember that whatever stop losses or take profits you place for a trader, they know those your stop losses goes to form what we call a liquidity pool. They already know where the majority of stop losses are, and they can actually spike a candle to go there to take up all those liquidity at those levels. Do you understand? Remember that for a market to move up or move down, there has to be some buys and some sales. And for someone to buy something, there has to be something available to be bought. So I want you guys to wire your mind to understand that trading, forex trading is really about buying and selling, but a more technical buying and selling. Don't overcomplicate it. It can be simple if you are being mentored by the right person. Okay? So that is that. Myself, I love choosing the raw spread, the ECN network. That's what I like. And if you are a scalper, all right, I'm not just a scalper. I scalp at times and I leave some trades to last most days. Okay, but in as much, I still prefer my ECN to any other broker because I know that it is a fair playing ground for myself and the broker. I'm not expecting anything from them. All right. That said, let's get to the business of the day. Market structure is what we say we're going to be covering today, okay? Now, market moves in basically, I'm going to clean this thing up now. The video is recorded, so you will get access to it later on. Let's switch to this chart right here. Let's switch to GBP USD. Awesome. Great. Now let's proceed. We have, like I said, markets can move in either three ways. It can go in an uptrend. It can go on a downtrend. Or it can be ranging. So what then is an uptrend? What is a downtrend and what is ranging? Look at this first move here. This is where a price starts. A candlestick, like we've learned, it moves up, okay? It goes down in this manner. It moves up again. It goes down, and it moves up again. Now, wherever you see this peak of a mountain, which is usually what I call it, whenever you see this peak, the peak is called the high, and this valley here is called the low. This is the high, this is the low. All right? So whenever you see this A-shaped, it is a high. Irrespective of the direction of the market, it is a high. But whenever you see the V-shaped, the bottom there, the trowel, is called the low, while the peak is called the high. Okay, having cleared that, there is something we noticed here. First, the market moved up to form a high. What next did it do? It goes down to form a low. Okay? What next did we observe? It moved up to form another high. But this second high, in relation to this first high, is higher than this one. Are you getting the point? This second high is at a position higher than this first high. So for this particular high, we call it what? A higher high. Okay? HH, a higher high. Now, how about this low? The market moved down here to form a low right here. For this particular low that has been formed, okay, it is at a position higher in price than this previous low. So we also call this one what? A higher what? Low. I hope this makes sense, right? So what that tells us is that whenever market is moving in such a way where it is making higher highs and higher lows, we say the market is in an uptrend. Are you with me? Beautiful. Now, on the other hand, when you now have a market forming this structure for you, it goes down, then it goes up. Remember, on going down, it formed a low. It now goes up to form the high. It moves down again to form a low, up, a high, down again to form another low. So what do we observe on this particular case? Let's check it out. Here, we had a low, we had a high. Now, we now saw another low, but this particular low, this current low, is actually lower in price than the first low. And this particular high was actually lower in price than the first high. So what does that give us? In this case, we have a lower low, and right here we have what? A lower high. Are we all there? So what that categorically tells us is that when a market is giving us lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, we say that market is on a what? On a downtrend. Do we understand that? If we do understand, please type yes on the chart. Type yes, type yes. I want to see the yeses, okay? If you understand, type yes. If you don't understand, type no. Let's give it 5 seconds. Let's be quick. Quick, quick, quick. Do you understand what an uptrend is and what a downtrend is? Are we there? Do we understand? Do we understand? Beautiful, beautiful. All right, let's forge ahead. Let's forge ahead. Now, the last structure is the ranging market. At some point in time, the market will now, instead of making higher highs and higher lows, or lower highs and lower lows, what you will now see the market doing is something like this. It goes up, it comes down to the same level from which it went up, it goes back up again and stops right here, it goes down to this level, goes back up to this level, and it will just be doing that forever a period of time. In other words, in this case, the market is neither making higher highs or higher lows, nor lower highs or lower lows. It is just moving from one range to the next range. In this particular structure, we say the market is moving sideways or it is in a ranging mood. We've talked about an uptrend, a downtrend, and then what? A ranging market. Now, what do we call a trend line and how do we draw a trend line? Let's take a look at how we can accomplish that. Markets move in what we call impulses and corrections, as you might have noticed in an uptrend. When a market is moving an uptrend, what do we say it does? It first of all goes up this manner, it comes down again. The movement of this particular direction is not as big as the movement in the upward direction, right? The movement in the downwards direction is not as big as the movement in the upward direction. It moves sharply up and then it moves slowly down and then it gives us another sharp move up, okay? It moves sharply up, moves slowly down, and then moves another sharp move. So what we say is this: the market moves in what? Impulses and corrections. I'm going to type it out here now. That sharp move is called what? An impulse. Why that counter move to that direction is called what? A correction. Okay? It is correcting that move that it made in order to make another sharp move again. So when you have a market forming an uptrend where it has already made this, let's clean up a little bit of screen. You see a market is moving in an uptrend. It has given you first an impulsive move up, and then it comes down correctively, and then boom, it makes another what? Impulse. This we call a monocycle. That is, the market has completed one cycle, and the cycle simply consists of what? One impulse, one correction, and another impulse. And it is a cycle that defines the trend of the market. If you've not seen a cycle, for instance, a market that moves up like this and moves down like this and then starts moving up in this manner, please don't tell me that it is now ripe for you to draw a trend line or do anything. No, it has not yet shown you that it's a fully developed cycle. Okay, it has to break the previous high for you to know that, okay, that cycle is complete. This is a very important factor that I've just pointed out here. As we begin to progress, you are going to see why it is really this important. Most people have taken trades that have reached the reversal mode thinking that it's going to still be moving in the previous direction just because they were impatient to confirm that a cycle, a complete cycle, has been made. So whenever you see a complete cycle or a complete cycle in your chart, okay, that is when you can now confidently put up a trend line. And how do we draw a trend line for an uptrend? You connect the higher lows, okay? The higher lows of a particular cycle is what you connect. And most people are fond of the fact that, okay, if a market has developed a trend line, they already have this trend line here. That will be the trend line that will govern them all through. Your trend lines need to be constantly updated as the market is forming. Another very important, I'm going to point out and I'm going to explain why. Now, we have this low here. Market moved up impulsively in this direction, right? And then it moves down here. And then it moves up again. So having forming these two lows, what we'll now do is look at on this my chart environment. This is trading view. Don't worry, possibly in our next class, I'm going to take you through on how to use this trading view. We've not got to that point yet, okay? I'm going to take you to I'll take you on a tour on how to use all of these features on this interface. But for now, this will suffice. You go to this second portion right here, click on it. I'm going to choose, you see what we have here, a trend line. This particular first line here called a trend line 2. I'm going to select it and I'm going to point out where I want this trend line to start. Of course, it will be starting from the first low. And then I am extending it to the second low, but I'll be projecting it all the way out, making sure it touches that second low. Beautiful. Just like that, I have successfully drawn a trend line for that developing market. All right? And what is the essence of this trend line? This trend line here serves as what we call a support for this market. Now, that brings us to this concept now. For those who have not learned about it, that have not heard me talk about it, we have what we call a support what and a resistance, okay, in the market. Price moves in support and in resistance zones, all right? Support is like a floor, like the bottom, the floor of your house, where let's say you bounce a tennis ball, it bounces on the floor and then it moves the way up, right? That floor, that price floor, let's say market is moving up, down, This price floor that it finds it difficult to break is what we call the support. While that zone at the top of that price movement, where it finds a ceiling, where it finds it difficult to break above, is the resistance. When a price finds a zone where it fails to break below that zone is what we call the support. But if it finds a zone where it finds it difficult to break above, that's what we call a resistance. Take that down and mark it out somewhere. So in this particular case, remember that trading is a business of probabilities. If anybody tells you otherwise, know that the person is telling you a big lie, okay? Now, having used a lot of data from the history, we know that market has a way of respecting supports and resistances. And the trend line, what it does for you is it gives you what we call a dynamic support and resistances. All right? So in this case, for an uptrend, what this trend line is doing is it is serving as a support for this price. So what this informs us of is whenever this price comes down again to hit here, there is a much higher probability that it is going to bounce off here and start moving off than there is that is going to break it and start going down. And what we want to do in a situation like that is to take advantage of that historical fact and take a buy trade such that we'll do what? We will earn all of this massive impulse as our what? Profit. Are you there with me? Does that make sense? Please, I'll need response at this level. Do we understand this? Do you understand this? 12:07. Beautiful. Collins said, kindly repeat. What did you miss, Collins? You can on your audio and ask it. Is Collins still here? Collins. Okay. Collins is, are you mixing up on something, please? If you aren't, let's proceed. Is Amadi Collins? Okay. Please stop. What did you miss out on something? If you didn't, let's proceed. All right, I can't hear calling, so all I'm going to do is possibly maybe later on he'll ask the question. We are going to proceed. Okay, that's beautiful. Most of us understood what was just said now. So let's progress. All right, so what we want to do, like we said, is to take advantage of that historical fact that whenever market gets to a support, it tends to bounce back up, and whenever it gets to a resistance, it tends to bounce back down. Okay, so this is for an uptrend. So this market, we are predicting that it's going to get here, bounce up, come back here, bounce up. That is the essence of projecting the trend line beyond where the current price is, so that we wait for this correction, get some signal here that the market is about to begin its impulse, take a trade here, a buy trade here, place our stop loss below here. All of these terms, don't worry, that I'm going to break it all down for you in later on in much later class, but just follow with me, just go with me here. Now you take advantage of this, take a signal that the market is about to go on this impulse, enter this trade, place your stop loss below here. Why are you placing the stop loss here? Because if by any means the market tends to break this zone and move all the way down to this level, it means it has decided to start going down. It's no longer going to be what? Going up again. This is very important. Okay, but when you've taken this trade and of course it now reacts historically like it has always done almost 70% of the time, you are going to get massive returns with this move that moved up here. Now that is for the uptrend, the trend line for the uptrend, and I now believe we all know how to draw a trend line. right? I now know we all know how to draw a trend line accurately, okay? So we are going to proceed further to seeing how we can draw a trend line for a downtrend. If the market is moving on a downtrend in this manner, let's see our downtrend. Market has moved down, right? It bumped up, moved down again. So this, like we said earlier, is a complete cycle. In this case, what do you have here now? The impulse is on the downside. Impulse, correction, and what? Another impulse. A complete cycle. Enough for you to now put your trend line. So you simply click here, tap your trend line, and what you really want to do is to connect what? The bottom here, which is the high of this particular downtrend to the preceding or to the succeeding high. You take this point, and then you project it outward, ensuring that those 2 points touch each other. You now have your trend line. So what are you expecting for this market? You're expecting that whenever it moves up from here and hits here, this your trend line, this trend line will serve as what this time around? It will serve as a resistance, no longer as a support for the uptrend. Does that make sense? It will now serve as the resistance. So once it hits right here, there is a high probability that it's going to do what? Drop again impulsively. So what you want to do is you capture this trade right here, a sell trade, place your stop loss somewhere above here, and then let you ride this massive impulse in profits. That is just it. All right. Now, there are situations where you will see a trend that has formed in this manner. Now, this is drawing why I told you that having a complete cycle before you draw your trend line is very important. There are situations where you are now waiting for the market to actually come up here to touch, but it wouldn't get up to this level. Are you there with me? It will just move up a little bit in this manner and then start moving down like this. Remember that on moving down like this, on getting here, it has already broken the low of the previous impulse. So what this thing tells you now is that you have again a complete cycle. And what is this new cycle this time around? It is no longer this first one, impulse, correction, impulse. Rather, it is this one now, impulse, correction, and a developing impulse. What that tells you is that this, your previous trend line, is no longer valid for this market cycle. You need to update it by taking your trend line again, trend line 2, starting from this cycle and then hitting it here and projecting it outward. This now becomes your current trend. Did what I just said now make sense? Let's respond. Quick response. Let's be quick. Beautiful.
Yeah, it makes
Awesome. So you have to update your trend line every
sense.
time the market completes a cycle. All right. So having done that, if the market retraces again, to this, it is a high probability chance that it's going to move back down again. Now, how about when a market is about to complete a cycle and to shift trend? We are going to see that right now. This is why nobody will tell you that he is 100% accurate in Forex. But with good risk management, even if you are, in fact, let me make this point clear now, and I have to set your mind straight. While discipline, I've always, hammered on it, is very important. Discipline and patience. Even if you are a 50% winning trader, guys, you can make a buttload of money from this trading. I'm going to show you the analysis right now. We're going to do that before we move from markets changing cycles, okay? I want to show you something. When I mean 50% winning trade, assuming you took 10 trades. Let's do this. You had 10 trades, right? Out of that 10 trades, a 50% trader means you had 5 wins and 5 losses. Correct? Good. 5 wins, 5 losses. That is it here. However, you stuck to your risk to reward strategy. And what is that risk to reward strategy that you've stuck to whenever you are trading? Your risk to reward for this particular, for this particular trader is what? Risk to reward is equal to 1:3. As a matter of fact, that is the least I take. But when I see a market has reached a certain zone that is a high probability of reversing and is giving me maybe 1:1.5, 1:2, I usually take it off there. Or I push my stop loss to break even. That is the practices I do, okay? So let's assuming you have a risk to reward of 1:3. Now, some of us now might not understand this concept. What is risk to reward? For every single trade you are entering, guys, please know that you have to be willing to lose a certain amount of money, and that is your risk. Does that make sense? And I've always instructed my students that your risk should just be between 1 to 2% of your capital. Are you with me on this? For every single trade you are taking, let your risks be pegged at a maximum of 2%. This will give you a whole lot of lifeline if you are really a good trader to recover whatever thing you've lost and even make much more money on it. Take for instance, your capital for trading is $1,000. Listen to this. $1,000 and you are risking only 1%. What is 1% of $1,000, guys? What is 1% of $1,000? $10, right? 1,000 divided by 100 is what? $10. Beautiful. Good. So you are risking for every single trade, you are willing to lose $10. So whatever position, whatever way the market goes against you, the maximum you will lose is $10. Know this and know this. Once you have this kind of discipline in you, that is the beginning of your profitability in trading. Now, if you have pegged your loss at $10 for a $1,000 account, right? And you are taking every single trade at the risk to reward of what? 1:3. That means you are risking $10 to make what? $30. You are risking $10 to make $30. Now, if you entered 5 trades, or rather 10 trades, you made 5 wins and 5 losses. Your 5 losses will translate to what, guys? Your 5 losses will be 5 times 10, which is $50. Is that not so? But your 5 wins will be what? 5 times what? 150. Because if you are risking, excuse me, guys. Hello, Silas. Yeah, my brother. Yeah, please. I'm in class now. Once I'm done, I'll call, please. Oh. Hello. All right. All right. Okay. Beautiful. Okay. Let's keep it there. Let's keep it there. All right. All right. Thank you. All right. Sorry for that. Um. So the analogy we are making here now is what? You lost 5 trades, you won 5 trades. Your 5 losses was what? $50. However, your 5 wins was what? 150. And what is your net profit? 150 minus 50. Guys, do you see that now? You're still profitable at what? $100. Even though you are even making 50 to. In fact, the exciting thing is this, guys. Let's assume in this case too, you lost let's see if this actually works. You are a 40% winning trader, but your risk to reward is 1:3. Okay? If your risk to reward is 1:3, you lost six trades. Six times 10 is $60. Is that not so? But guess what? 4 times 30 is what? 120. Even at 40% winning rate, with a risk to reward of 1:3, you are still making money from the market. It's just for you to understand that strategy that you are using, but texted it so much so that you are confident in it that no matter the loss that you make, even their consecutive loss, that the strategy still goddamn works. Not be jumping from one strategy to another. Does that make sense? Once you have established a strategy, you stick to it. Find out its what I call the statistical edge, the statistical significance, its high probability of making a win in the market, and then stick to a very strict risk to reward, and you're gonna make it from the market. Okay, so this has kind of deviated us a little bit. Now, imagine a situation where you have this level of discipline with your risk to reward, and then you are being taught by me, you are mentored by me, where your winning rates will go as high as 80%, 90% in a trade. That means you'll be crushing it in the market almost every time. You might get break-even trades, but your losses will be reduced to the barest minimum. All right. So we've talked about the trend line. Now what we want to talk about, we've talked about the trend line, drawing the trend line for an uptrend, for a downtrend. Now what we want to do now is to cycle. Let's assume a market has been trending up, going down for a while, and then it is now about to switch direction. All right. After this, we're now going to go to the chart and look at all of this in the chart, and it's no longer going to be on the lines, so that we have a real feel of it from the chart. All right. So that said, let's take a look at this scenario. I'm going to clean up the screen to make some space for me. Let's take a look at this scenario. The market is now going down. First of all, you saw an impulsive move down. You waited diligently, it corrected up, boom, and then it gave you another impulse down. You are like, ooh, the downtrend has been established. What do? You pick your trend line. You now draw your trend line, connecting the lower highs and projecting it outward like this. Now, true to what you expected, the market moved up here again. You know that the probability of it moving down is very high. What do? You take a trade here, boom, a sell trade. Sell trade means that you believe that the market is going to go down. You enter on that sell trade, and boom, the market went down, and you make your money. You cash that first win, right? The market moved up again, corrected. You also expect it was going to go down. You take another sell trade, boom, and you make that money, you bag it in. Now, the next time, the market now got here. So you still believe strongly in your statistics, right? You still believe strongly in your statistics. And you said, okay, since it has hit here, the chance that it's going to move down is very high. Now, let's assuming that you did not wait for any other confirmation, any further confirmation on analysis. You are just trading off support line and resistance lines or your trend lines like this. And in this case, the market, you now take your sell trade, hoping it's going to go down. And the market played the first one on you by doing what? Smashing this trend line and going up. Boom. What has happened in this case, guys? You have lost this particular trade, isn't it? This particular one, possibly you put your stop loss here. You have lost this. Remember, the amount you lost now is just this small from here to here, compared to all the wins you've been making. This was your win. This was another win you made from the market. You see that even though you have encountered one loss, you had two wins and one loss, and with a massive return on investment. Massive risk to reward ratios right there, right? So what you will now do is like, oh, I've lost this one. No, what that simply means is that the market is now changing what? Its trend. Does that make sense? Will you jump in and follow this market in this manner and start going up with it? No, capital no, because the market has not established itself yet. You need to see what? A correction and another impulse for you to now to become convinced it is now going up. Now, what does the market now do afterwards? Let's check it out. The market now went down, corrected here. Most times it usually comes back to that trend line to correct. And what that simply tells you is this: when a previous support is broken, it becomes resistance. This is a very important point to note. And when a previous resistance is broken, it becomes support. Let me write it. If a support is broken, it becomes resistance. Let me bring it to the next line. It becomes a resistance. And if if a resistance is broken, it becomes a support. Okay? Very important point for you to note here. If a support is broken, it becomes a resistance. If a resistance is broken, it becomes a support. Right here in this particular trend, the market has been trending down, isn't it? The market has been trending down and has respected this trend line here. And this trend line has been serving as what? A resistance, a ceiling, where the market has not been able to break up until right here. Now you see at this moment, the market broke up here and then it has now moved down and has failed to break back into the line. This shows that this previous resistance is now a support at this particular level. All right? And what you have seen from this is a complete cycle. The market has moved up, moved down, and it has moved up again. Now, you have now confirmed a full wave for you to now draw the next trend line. And the next trend line will be connecting what? This time around, it is no longer the lower highs as of before. It is now the higher lows of this particular direction. All right? So you pick your trend line, touch the first point, touch the second point, and project it all the way out. This now becomes your governing cycle. So what are you expecting from this market right now? You're expecting from this market that whenever it comes down here on this trend line, your anticipation, the probability that it's going to go up is way higher. So you prepare yourself, take a buy trade, and capture this next impulse. It comes back down, you take another one. In that manner, you now capture all this. All right? And then, whenever this market now comes back again and smashes this particular trend line, what happens? Remember that this trend line here has been serving all this while as a support. But right now, it has broken it. So the probability now is this. This movement that was supposed to be a correction now is now an impulse because it moved impulsively, so much strength that it smashed that trend line, so much strength that it went below it. So it is now an impulse. The next thing that will happen now is a correction that will now possibly come to this trend line, and then the market continues its cycle down in this manner. I have just broken the market in its barest simplicity for you guys. If you understand this, you have understood at least 60% of what you need to become a profitable trader by just watching the market structure. Now, a situation like this, let's now see how a ranging market could come into play in this case. So let's put our trend line for this one like this, okay? And what happens again? The market now comes up, breaks this one, all right? On breaking this particular line, it now comes down corrected. So you were expecting it to make a new high, but it came up here and it stopped. Came back here, stopped. Came up here, stopped. Came back here and stopped in just this direction. When you see this happening, it means that the market is now ranging. And what you will be expecting is a breakout, all right? If the market breaks out from this range, that means it is now ready to move in a particular direction. And the trend is your friend. That means if a market is moving in an uptrend, guys, the only trades that you should be taking are only buys, going long. You shouldn't sell in an uptrend, no matter how much of an expert you think you are. And if a trend is going down, always wait for a correction and take a sell trade. In other words, take a trade in the direction of the trend. It will help you maximize your returns. This simple fact cannot be overemphasized. All right. So for this particular trend, ranging market right here, let's say the market now breaks up from above here like this. Boom. Remember that this zone, all this while, has been acting as what? Resistance, isn't it? So on breaking it out, what will it now be? It will simply become a support. It is going to come down to this and bounce back up. Once it bounces back up to give you a higher high, a high higher than this one, remember, that's what we say a higher high is. That means the market has resumed its trend in the upward direction and it could likely continue to go in that manner. All right. Do we all understand up to this level? Okay, someone asked a question. I'm going to address that. Please, can you explain the risk to reward aspect? Is it tied to leverage? All right. The question, do we understand up to this before I attend to that question? Okay, I'm only seeing Asoba's response. Do we all understand up to this level, please? Beautiful. So someone asked, awesome. All right. This is great. Now, someone asked, can we explain the risk to reward? Is it tied to leverage? Okay. There is what we call a. Let's get to that. Let's attend to that. Okay. We can invariably say it's tied to leverage, but that really doesn't answer the question as it ought to. All right. Remember, you funded your account with what? $1,000 in that our example. Listening to this calculation, I want to make it much clearer, okay? But all of these things, don't worry, in advanced classes, as we keep progressing, there are simple tools that will help you to calculate your risk to reward, all right? There is a simple tool that will help you to know the lot size you need to put so that if a market moves against you by a certain number of pips, that's the maximum amount you will lose. Take, for instance, you enter the trade. Let's you have an account of $1,000 right here, okay? $1,000. Okay. Now the maximum you want to enter a trade. And remember, for you to enter a trade, you need to put in what? You need to buy or sell a certain lot size. And we say one lot size is what? We say one lot size is what? 1,000 units of the base currency. Is that not so?
$1,000.
Beautiful. 100,000 units of the base currency. When you say one lot size, one lot is what? 100,000 units of the base currency. Then we also talked about a mini lot, which is 0.1. zero point 0.1 lot. Okay? And zero point 0.1 lot is simply what? 10,000 units of the base currency. And what is the base currency? For GBP USD, we always say that the base currency is the currency on the what? On the left hand side. This is the base. So if I'm saying I'm buying one lot of GBP USD, it means that I am using my United States dollars to buy 100,000 pounds. I'm just trying to make a record to what we talked earlier. Okay? Now, having known that, we also did a math last week. We did a math last week that shows that if you are trading a one lot size, right? If the market moves in your favor or against you by 1 pip, you have either made or lost what? $10. Do we remember this calculation the last time? Do you remember that?
Yes. Yes.
Beautiful. So we say that if the market, if you are trading one lot size, okay? If the market moves in your favor by 5 pips, guys, you have made $50. If the market moves in your favor by 5 pips, you have made what? $50. Because 1 pip move on a one lot size is $10. Now, imagine you are trading a $1,000 account, like we said here now, and you put your stop loss at 20 pips. In other words, you are saying if the market goes against me, let's assume that you enter the buy trade and you are like, okay, I believe this market is going to go up, but if it goes against me by 20 pips, cut me off from the market. And then you entered with one lot size. If you entered this trade that you set the stop loss at 20 pip with one lot size, what it means is that if it eventually goes against you and hits that 20 pips, how much would you have lost? $200.
200
Exactly.
$200.
Is this making sense now?
Yes. Yes.
Good. And if it's in your favor, you've made $200. But remember, I always tell my students, listen, in forex trading, you shouldn't be much concerned about your profit. Just be good at what you do and then manage your risk. You should be concerned about how you manage your losses, how you preserve and protect your capital than in the profit. Your profits will definitely come if you are good at this. It is managing these risks that is very, very important. Now, if you become a risk manager, that's what is going to give you the confidence to know how much you can risk in the market and how much you want to make in return. Now, if you are trading a 0.1 loss size, on the other hand, 0.1 loss size, we also talked about it last week. We said that if the market moves in your favor or against you by 1 pip in a 0.1 loss size, what you have lost or gained is what? $1.
$1.
Right? So that means if you are in a trade that you entered at 0.1 lot size and you placed the stop loss at 20 pips, like say you entered the buy trade, this was a market up, down, and then it's about to go up, you enter the trade here, a buy trade, you bought here, you believe it's gonna go up like this, right? And then you place your stop loss below here, and the distance between where you enter this trade and here your stop loss is about what? 20 pips. Okay? And then eventually the market played the fast one on you and it pulled down and reached here. On reaching these 20 pips, it cuts you off. But because your lot size is 0.1, how much will you be losing in that case?
$20.
Exactly, you are just losing $20. Beautiful. That is why for any single trade you are entering on forex, you must put your stop loss. That is your risk management. Even my students that I fund, even if you are a profitable trader, and I now go, okay, you have reached the level, the time I'm about to fund you to trade with real money. You've reached that level. I will go to your trading history and check every single one of your trade. If I see any trade, any single trade that you don't have an SL put in, because after you click buy or sell in a trade, the next thing you should do for me is place a stop loss. If you don't put any stop loss, it automatically disqualifies you. You are not a good, you are playing with someone's money. You are just playing with money. Imagine now, look at this particular analysis that we gave here now. Imagine that this person right here did not put this stop loss here. Okay? The person did not put this stop loss right here. Are you getting it? And this market, and let's say the person, what he entered was one lot size. The person entered one lot size. And this market, instead of putting a stop loss to limit the loss, it moved all the way down and moved a total of 100 pips. 100 pips from where the person entered the trade. What has happened in that situation? 100 pips on a one lot size is equal to how much? $1,000. Is that not so? That means the person has blown the account.
Yes.
That $1,000 has been blown. It has been lost. It cannot be recovered. You're not getting any damn thing again. You guys have to understand that about FX. But this shouldn't scare you. It really shouldn't scare you. Because when you have attained mastery in this, okay, it becomes very, very easy for you. It becomes very easy for you. Okay? Now, you should always put the stop loss. So your quest, this is what we're going to talk about in a different class. Your quest, after understanding this calculation, now what you want to do is, okay, I now know how much I want to risk for this trade, 200 loss size, and $200, sorry. I know now that I'm ready to lose my $200. I am happy with it. I'm at peace with it. So since I want to lose $200, I also know that, okay, this my trade. I only want to allow it to go what? I only want to allow you to go 30 pips against me, or 15 pips against me, or 10 pips against me, whichever number of pips from your calculation on the chart. Now, how many lot size should I trade so that it will correspond to, let's say if I get to 30 pips against me, I will only lose $200. If it were 15 pips against me, I will lose $200. If it were 10 pips against me, I will lose what? $200. Does this make sense?
Yes. Yes.
Good. That is exactly what we're going to be. I think one of the things we'll be discussing in our next class is not what we're going to be doing here on this class. We are still talking about market structures. We're going to do that, and I'm still going to give you guys a tool that will make that very easy for you. You don't always have to be doing the calculations manually. Okay? So let's take a look. Remember, we've talked about uptrends, downtrends, and ranging market. Now, what we want to do right now is to take a look at the charts directly. We want to look at the charts now and see how we can identify these structures in the market. All these confusing things in the market here can be simplified into what we've just learned: uptrend, downtrend, and the ranging market. Simple. Now, let us identify some of those here. If you look right here in the market has been going for this particular zone. Market has been going down. As a matter of fact, the GBP has been trending down for a while. Now, do you see why I said you should always trade in the direction of the trend? Because once a trend is established, if you start trading in that direction, it's all about cashing in on your profit. But imagine someone taking buys here. Look at how, by how much. Okay, let's take a look at this. This was an impulse. Guys, you see this? This moved down impulsively. We had this correction. All of this, when we start learning about patterns, we learn more about this. But now we are simplifying it all for you. All this move that move at the direction opposing this impulse are corrections. After that, we saw another impulse here. Boom. All this move going against this major direction, and it's a correction. After that, we saw what? And what do you observe here? What is the characteristic of an impulsive move? An impulse is usually sharp. Do you guys see that? An impulse usually moves sharp down, and that is where the money is. All right. Now, even if we want to break down a smaller phase of this market here, let's take a look at this one now. Look at this small uptrend inside an uptrend. I know that might sound a little bit cryptic. An uptrend is an uptrend. As we progress, we're gonna know about all of those because we say the market moves in waves, and waves are like fractals. Okay. Let me not complicate things now. Let's just make do with what we have learned and dissect the market based on the knowledge we have amassed so far. Take a look at this. First of all, market moved down here, then it moved up, guys. Watch that move here. Market move from here to here, up, impulse, and down, correction. What else? Up, impulse. We have a cycle here, up, down, up. What do you do when you have a cycle? Like I have taught you, use your trend line, connect the zones, the bottom of this, the bottom of this, and then project it all the way out. Does that make sense? Are we following?
Yes, yes.
Markets move down, forming a low here. It moved up, formed a high, went down, formed another low. So I have two lows, this and this, and I use it to project my line up here. So while I did this, I'll now wait. The market has moved up again, and they have moved down again. Now, on moving this down, this particular candle actually broke here, but look at the second one. It came back in. When we start talking about strategies, we will now know what we call a fake breakout. We're going to learn about this later on. So, in essence, the market pushed down. If it were supposed to continue down, the next candle would have been another red candle. And this red candle that comes next would have confirmed that, okay, this trend has ended. It is now ready to start moving down. But after this first red candle, what happened? We saw a green candle that tells us that this guy is still about to move up. And it is on seeing this green candle, the end of this green candle, that we are going to take a trade. What do we then do? We come here, we take a long position at the end of that green candle. When we start learning about candlestick patterns, we're going to learn what we call a bullish harami candle. This red and this green here form what we call a bullish harami, which is an indication that the market is going to go up. All this will be broken down. So don't worry, don't be too curious about them. So on taking this trade down, I will tell myself, okay, since it has made this low, if it breaks down this low again, that means it is now going down. And my take profit will now be somewhere high here, and I'll be monitoring it. Now, all these things are advanced techniques. I'm just doing this random. Where you place your take profit and where you place your stop loss. In later classes, we know that precisely. All right? So that you don't place your take profit somewhere here. The market will now reach here, and we do you, the more you look, the less you see, and then come all the way down here to wipe you out. So some people are greedy to do that. They will enter a trade, they will place their take profit at an outrageously high position, only for the market to have moved some substantial they have made some substantial movement in their direction and then reverses against them, having them lose all the money they have made. So in advanced classes, you're going to learn where exactly you need to place your take profits and your stop loss so that you will always be ahead of the market. So just like what we are seeing here now, impulse, correction, impulse, the market came down to around that our trend line, gave us a bullish signal, we entered the trade, and boom, we captured it. Are you seeing it? All of this from here to here now is our profit. But what happened afterwards? See right here now, just like I told you guys, even in this particular one, see right here, look at where the market broke this trend line again. Let's bring it down. Do you see this? On breaking this trend line, what did we see? A red candle. When we start learning about candlestick patterns, we know that this candle here, this red candle here, is called a shooting star. And what it means is that the market is about to go down. It says in between a shooting star and the gravestone doji, okay? And look at the next candle. The next candle was red. Do you see that now? So remember what I told you, that whenever a trend line is broken, the market usually does what? It comes back to it to retest before it continues ease down. Now let us try projecting this our trend line. Let's push our trend line up a little bit further. Watch, following this particular direction, following it, following it, following it, boom, just like that. Do you see the market exactly did what we have studied analytically? The market broke the trend line here. It went back up to retest that trend line, and look at it going back down. And that is how this market moves. Market is not as complicated as most people say it is. It is only dealing with your emotions, which is where I've helped both my VIP students and my normal students, okay? Which is where I've really helped them to conquer. Because at this level, every of my students, what runs in your body now is no longer red blood, it will be black blood. Because when it comes to the market, you will be totally emotionless. You will be purely a logical person, basing your trades statistically than emotionally. And once you do that, that is your success. That is how your success is confirmed in this. Now, look at what happened again, guys. Look at what happened again. This is beautiful. When the market went down here, we know this was an impulse, right? So what were we expecting? We're expecting it to do what? Move up a little bit, right? And come down again to continue moving down. But what did it do? The market moved all the way back to that initial level that it reached. Guys, do you remember what we call this kind of market? A ranging market. Beautiful. Market got here, went down, got here, went down, got here without breaking this high. So the market is now ranging. Okay? Now you have this zone here. Look at the support zone here. You place your horizontal line at these two levels. Let's place it. The first level is the one on this high. You have your horizontal line on this high, and the next one is the one at this low that was formed. So what you are expecting basically on this market is the only time you consider taking a trade is when this market has either done what? Broken above here, retested, and continue going up, or it breaks below, retested, and starts going down. And what do we now see happen to the market, guys? Look at the chart. Just look at the chart. Around that price zone that we have earmarked, around that price zone, which is around this particular zone right here, around this price zone, the market did what? The market broke this zone, came back to it, broke it, and entered inside again, right? Watch out. It's now failed to reach this high. Guys, what this very carefully. It now failed to reach this high, and then it breaks it again downward. When a market has done this, listen, from what we have learned today, when a market has moved down, moved up, and this upward movement fails to reach this high level, what does that tell you? The market is about to start a downtrend. Is that not so? Are you there?
It is.
Good. So
Yeah.
what you expect is for it to do what? Come to break this level, to complete a cycle for your trend line. Then you now exercise that patience. It now comes down, boom, it breaks it. A trend line has been formed. You now place your trend line in this manner. With experience, you will know that at some point you don't need to waste all of these moves. you can actually enter trade now. But for now, I want you guys to wait for a cycle to complete to place your trend. Now, let's analyze what is on our screen right now for this particular market. This market moved down here. Excuse me. We have this impulsive move down. Now, do you see how this guy moved up? And then we started seeing price actions here. We started seeing rejections. It is this rejection that is telling us, oh boy, this market is likely not gonna head up here. And true to it, the market now broke this thing again. On breaking this, we now saw that the market has given us a trend already. The market has given us a trend. And what is that trend? This was the high, and this right here is the what? The lower high. Is that not so? So we put this and connect this to this level, and it gives us this projection of a line. But I told you that you only wait until it breaks the low of the previous impulse. And where is that low? Let's place the horizontal line on it. This is exactly where the low was located. Is that not so? Boom, this is your low. Now look at what the market did here. We had a low, a lower high, and then it smashed this one for a lower low. On smashing it, which is a zone, it now did a little bit of a retest here, guys. This, if you're a skilled trader, is where you know that you need to enter this trade. And look at what happened afterwards. It was all direct descent. All of these are money. Now, let me show you. I've taught you guys how to calculate pips here. There is a tool in this platform that helps you to calculate pips quickly. It is called this measure tool here by this left hand side. So once I click on the measure tool, let's check from where this zone was broken all the way down by how many pips that is. It went all the way down to this. This is a whooping 263.5 pips. What does this tell us? If somebody entered this trade, a sell trade, right? If somebody entered this sell trade with a one lot size is $10 per pip. That means the person has made what here? $2,635 in a single trade. And in how many days? Let's check how many days. From here to this other red candle. It's not even up to 1 day. In just 15 hours, you have made your 2,600 plus. And 2,600 plus with the current rate in the market, dollar is about 590, 595 now in the market. So 590 multiplied by 2,600 is what? That's 1.5 million that you make from the market in just 15 hours. Most of you who watch my status know that I post my trades there. And most of you who've been my followers, even most of you that saw that even before I take trades, I make the analysis and post them there. So that you don't say, okay, this guy has just taken a trade first before he now pastes it. No, I don't bloody do that, guys. Sorry for the language, but that's it. I will tell you most times around 7, 8 in the morning, I will tell you, okay, this is a trade I'm looking out for. I've entered it. So you guys, most people will actually watch if it goes in my direction or not. And eventually, I will tell you how much I make in that day. For this week, I did not trade yesterday being Friday. I was doing some other things. Okay? The last trade I took for the week was on Thursday. And that last trade gave me $1,500 in return. And it was just, I placed a 5 lot size on a GBP JPY. We're going to come to that. For all these things like analyzing GBP USD for you guys now. That's GBP USD is where we are currently. You will understand that as you grow as a trader, you choose your currency pairs that you have to stick with. Mine is GJ, which is GBP, JPY, and gold. That's what I've actually stuck to. But I still do the analysis for all these other ones you see by the right hand side to send to my students to give them some signals most times. All right. So that is it basically. So you see that this can actually make a lot of money. And for this particular move in this market, we have entered the trade on just this retracement. You see that the risk here is very small. Look at it. We are risking only about 23. Even if you place the stop loss at 20 pips, it wouldn't hit there. Imagine 20 pips to make what? About 200 pips. That is a whooping amount. Now, after this massive impulse, let's say the person missed this impulse. Do you understand? You now start waiting for the next impulse. The market now moved all the way up, moved down, moved up, and this up that it moved did not cross here. Market is already ranging. You already have a trend here, but it is now ranging. When we start learning about patterns, we know why this is called an ascending triangle. There are a lot of things to learn in this trading stuff, but I only teach the relevant ones to my students. Nobody dey write PhD for this. Your result is only if you are making money or not. It's as simple as that. So now see what the market is doing for these particular zones. Watch out, guys. For this particular zone now, check it out. After this first impulse, patience, like I say, is a virtue of the gods in the market. You have to be patient. Patience cannot be overemphasized. And it is discipline that will only make you patient. And there is no truer place that they say in the patient dog eat the fatted bone than in trading. Okay? So right here, the market has moved and it formed a range here. All you have to do is earmark that range, earmark dates. As long as market is trading under this range, you stay out from it. Wait for a breakout. If it breaks above here and retraces, you know it is now starting to go up. Once it moves a little bit of up, enter the up movement, enter a buy and enjoy the impulse up. If it breaks below, just like we saw, and remember that we know that the market, we know that for every impulse, there will be another impulse. Whenever, in fact, this is a rule you need to write down. For every impulse, there will always be another impulse. And in between them is a correction. For every impulse up, there will be another impulse up. And in between them is a correction. Good. So having said this, look at what happened here. The market now started moving in all this manner, all this motion. You now have bridged out where the market should break before you take action. And look at what happened. The market came down here, broke it massively, right? Look at the first candle. This was the only candle. This was the only candlestick that closed below this range. All of this one, you see how they were having pullbacks. All of these ones were all having pullbacks. So studying candles and price actions will tell you that this was the ripe one because that is the only candle that closed below it. So on closing below it and it moved up a little bit and start moving, myself would have taken the trade right here. If you are some other person who is waiting for a very clear structure of an impulse, correction impulse, maybe you would have wasted this move here. But you are not still late to the journey. What happens? This market has now moved down here. It moved up here. And then once it starts moving down, you are now in on this trade. And look at what happened afterwards. Another impulse that completed that cycle. Do you see that? You now have another impulse that completed the cycle. And you would have benefited from all of this move right here. And then it starts moving up again. The same thing, market repeats itself. Look at all of this, correction again. And look at the breakout here. Boom, you are in on this trade, another sell. You see all of this while we've been taking sell trades because we know that if we enter the right sell trade, it is going to be a massive reward for us. That is why I tell you the trend is your friend. Does this make sense, guys?
Very well.
Beautiful. Is there any other person? Is there any confusion here? Do we all understand this? I need responses. I need responses. Are we all there? Please type. Let's see if we are in. Do you get what we are saying? Do you understand this?
Well understood. Yeah, it's well understood.
Beautiful. All right. Oh, beautiful. Okay. So that is it, guys. We have actually elapsed our time. To recap, what we covered basically today, we talked about the brokers, the type of brokers we have. We say we have the market makers and the ECN, the Electronic Communications Network. We gave an example like Binance. We also have some brokers. IC Markets is an ECN. We have brokers, I think, like OptaFS, Market Makers. We have a number of them. You have FXCM and all of that. So if you're opening an account with any broker, what you should be looking out for is what their offerings are. Are they an ECN or a market maker? A dealing desk is another name for market maker. A non-dealing desk, or what we call STP, straight through processing, that is for ECNs. Okay. Example is what you see on your Binance. You can see directly how transparent the orders are. People all around the world trading with you in real life. How the order flow is moving, the buyers and the sellers. Okay, so we talked about that. We talked about the brokers holistically. We also talked about market structure, which is the foundation. If you get the foundation right, every other thing will be very, very strong. All right. So the market structure, we talked about the uptrend, and we said the uptrend occurs when the market is doing what? The market is making higher highs and higher lows. Are you with me, guys?
Yes, yes.
All right. When the market is making higher highs and higher lows, then we also talked about how to draw the trend line for an uptrend. That a market moves in impulse and correction. So when you have the first impulse up and the correction down and another impulse, you can now place the trend line by connecting a straight line on the higher lows of the uptrend. Then for your downtrend, you have your lower lows and your lower highs. Okay, so and the trend line connects the lower highs. In other words, the trend line for an uptrend acts as a support, a dynamic support for the prices, while the trend line for um, a downtrend acts as a dynamic resistance. We also saw how the market can switch from an uptrend to a downtrend. Okay. We also saw a ranging market. What happens in the ranging market? We now went to the chart to see examples. We talked about the structures of the market by seeing some very basic examples. And we said that the trend is your friend, that you always try and trade in the direction of your trend. Now, we'll see in later classes why this trend can be with respect to the time frame that you are trading on. For instance, we are in the 1 hour time frame here. And when I say 1 hour time frame, it simply means that each candlestick that you see on the screen here represents 1 hour, or it takes 1 hour to complete a candlestick before another candlestick begins to form. And after 1 hour, the next candlestick begins to form. So if I switch from 1 hour here to 4 hours, let's check that out. Boom. So what happens? What has happened here now is the market has shifted in such a way that one candle is no longer 1 hour. It takes 4 hours for the candlestick to complete. And as we begin to actually place real trades, trial trades, and the likes, you will understand that it's better to actually trade on the higher time frame. It is the higher time frame that gives you a better view of what the market is doing than the lower market. And I usually use this illustration. If you are given an option, you have a basin of water brought to you, and then a speckle of dust is dropped on that basin of water and then ruffled. When at what time will you be confident enough to take a cup, scoop water from that basin and take? Will it be after 3 minutes, 1 minute, 5 minutes, or will you wait maybe say 1 hour, 4 hours? I believe you wait for the higher time frame. Is that not so? Right?
Yeah.
Because the water would have settled, the dust would have settled, would have decanted, and you can now scoop the up. The same thing happens in the market. Those that do go to the lower time frame, the lower time frames are very, very risky. There is quite a lot of impulse there, and it is hardly directional, right? So you see a lot of spikes, a lot of shadows at the lower time frame. But once when your view is on the higher time frame, you will now see, okay, these patterns that this market is forming is way more reliable than when it has formed it on a lower time frame. So all of this will be discussed as we progress in this. One thing I want you guys to try as much as you can to keep the group alive. Do your own personal researches, try out trades, post your trades. Let's try and grow this community. Invite your friends and let's grow it. We really want to create a level of sensitization to tell people that one, forex is not scam. Rather, it's mostly people, dealing on forex that don't know how to do it. Imagine I had a friend. He's a top software developer back in those days with Andela. He has left Andela now, working with a big firm, a software developer. So he tried out Forex. When he learned that, okay, Forex actually paid my bills, he was bloody surprised, right? He was like, okay, that he never believed in that thing, right? He has put in about $500 and it all went to the gallows in Forex. So he has tried with even smaller amounts to no avail. So when he learned about it, he was shocked and like, damn. So ever since I am trading his capital, okay? Ever since I'm trading his capital, and I've been encouraging him. Okay, we are close knit friends. I've been encouraging him to learn how to do it himself because I encourage people, guys. Listen, in as much as you might have someone who knows how to trade or how good to trade, there is nothing better than managing your own capital yourself. Remark that, mark that. Most people that have been duped or most people that have experienced that have had very bad experiences with the finance world are people that have entrusted their finances to some other person. Yes, I might be good at it, but what stops you from learning it and managing your own finances? You are better comfortable and disposed to managing your finances than when you entrust it to another, person. All right. So with that said, I will urge you guys to learn this is a skill that does not leave you, no matter how old it is you are. You will take it to your grave. Learn it, live it, become it. So with that, we're going to call it a day for today's class, and we'll see you during the week if there are any opportunities and if I have the time. And of course, we'll have another section in the weekend. All right, guys. Thank you, guys, and we'll see you next time or in the chat. Bye. So, okay, before we close, do we have any questions? I can take within the next 2-3 minutes to have any questions. Or please, if you have any question, let's take it to the group so that we don't make the recording too long and irrelevant. Okay. All right, guys. See you guys later.